Hi, do you ever play fantasy football? Or fantasy soccer? Or fantasy basketball? Some friends of mine are addicted to such games. What about me? I am addicted to fantasy portfolios. I also mentioned them in my last book, The Advanced Route Investor, as part of my ongoing investment self training. In fact, I have more than a dozen of such portfolios. But wait, what is a fantasy portfolio? It's this. You create a new portfolio in finance.yahoo.com. You give it a descriptive name and a date as part of the name. Then you decide what you want to test. Like what? Oh, for instance, stock charts. The program I use to look at the gyrations of stock prices, it has a calming effect during trading, ranks stocks by how well they have done over the last year. They call it SCTR, short for Stock Charts Technical Rank. I call it scooters. The SCTR is a number between 0 and 100. The higher the number, the stronger the stock did versus the market this year. This number helps lazy traders see quickly which stocks have done better and which have done worse. Okay, now what? Now, assume you want to test if the market's recent top performers continue to outperform, if you hold them until they stop outperforming, and then you kick them out and get others who outperform. How to test that? Well, in the fantasy portfolio you just created, you put the top 10 scooters, as I call them, and say put 10 grand in each, notionally. And to do that, you divide the 10 grand by the latest stock price, get the number of shares, and input it all into the portfolio as a buy. There's even a place to subtract commission, say $10. You now have a fantasy portfolio of all the top big cap scooters as of today. And now what? Now you also put one share of SPY, that's the market ETF, just to see what the market has done in the meantime. And now what? Now you wait a month. With a month over, it's likely that barring individual disasters in one or two stocks, your portfolio will do better than the SPY, which that too is in your portfolio, but in a very small amount as a reference. But with a month over, now comes the interesting question. When should you sell any of the 10 stocks? It's like trading out the player in fantasy football or basketball and getting another one. And this is what you really test. Assume you decide that if a stock did not reappear in the top 10 list the following month, you sell it out, and then you buy the top new stock in that month's top 10 scooters. It's like fantasy basketball when you always buy the best performing player, so the best basket shooter, by trade him out whenever his basket scoring falls. And you, of course, pay $10 commission for the old stock you sell and $10 for the new stock you buy. On the side, you can keep a record of the net asset value, the NAV of the portfolio, which finance.yahoo will give you. Then again, you wait a month. This second month over, you rinse and repeat. Any current stock that did not appear in the next month's top 10 scooters, you sell and you buy a new one, the highest rank from the new top of 10 lists. And now you wait another month and rinse and repeat on a monthly basis. Okay, now again, here's some of you saying, why do I need to do it by hand? I can pay a programmer to backtest this method on a database to see if it does better than the market. Or if you are a programmer yourself, you could do it yourself. My advice is don't. The point is, you doing the buying and the selling is part of the test. Yes, you. Why? Because, for example, we'd want to see if this takes you too much time. If you did it for real, which you may decide to do one day. Or you want to track the number of mistakes you make on the way. Everybody makes mistakes, me too. Or you track any other issue that crop up in reality. Because remember, the aim is to teach you what works for you and what doesn't work for you. All right. Another year has passed, full year. Every month end, it took you half an hour to kick one or two stocks out and get one of new stocks in. Not long. What was the result? Say the top 10 scooters did meantime 40% for the year. The high momentum performance other way, while the market did 15%. That's great. But does it mean you can now shift all your portfolio to it, buying high scooters only? Not so fast. First, even a full year of testing won't tell you what such a strategy would do in the long term, that is several years, or even many years. For example, if the market, that is the SPY, would plunge 60%, as it did in the great financial crisis of 2007-2009, would your top 10 fall too? Most likely they would. But would they fall less in the market or more? That is debatable. But as they say, live by the sword, die by the sword. So a high-flying scooter is much more likely to crash more than the market than crash less. And so this high-momentum strategy could really be similar to an insurance company insuring against a hurricane. Why? Because a hurricane insurer for 5 or 10 years would get fat premiums. But then, one year, a hurricane would come, and the insurance company would have to pay through the nose and maybe even go broke. The same with the above fantasy portfolio. It can do very well for a few years if you only buy the highest performance, and one day it would crash like the great financial crisis, if one of it comes, and it will flame out. What to do then? Discard it altogether? No, not yet. Let's try 2 refinements first. Remember, it's only on paper, so it doesn't cost you any money except time. The first refinement is, with such high returns, you can hedge. Hedge how? Well, you can keep shuffling the top scooters, as I said above, but on the side, you also keep a short position in the SPY for an initial amount of 100 grand, same as all the scooters combined. And as the portfolio value grows, you raise the short SPY position so it always matches the size of all the long stocks. This will provide you insurance against a huge decline by minimizing the expected drawdown, top to bottom, to the stock averages less the SPY decline. Of course, it would also cost you performance all along, as you keep owning a rising SPY in a short position. Now, say the top 10 scooters shuffled monthly did 40%, whereas the SPY did 15%. If you hold the SPY short, and you always keep it there, if you always kept a fully balanced long-short portfolio, the annual performance would then only be 25%, the 40 minus the 15. And if the market crashed 60%, and the scooter crashed, say, even more, 75%, your portfolio would crash only 15%. Well, you probably say, 25% steady with a Tworks 50% drawdown is yummy. That's a ratio of 1.7, what they call a Sharpe ratio, which is wonderful. So why not do it? For at least 3 reasons. The first reason, the above is a fantasy performance example, taken from my own past few years of playing fantasy portfolios. Second, it says nothing about what would happen if the market fell 80%, as I expect it might in 2026, 2027, and some of the top scooters may go broke. That is, some of the 10 will go to zero. But third, even if all goes well, the above is only good if you have full authority to act. If, on the other hand, you are working for bureaucracy running other people's money, like a bank, money management company, or a mutual fund, very few there have full authority to trade. Also, 10% in one stock is too much for them. Even 5% for 20 stocks is too much. So it may take you much longer to implement. And on the way, you may have 5 meetings for each trade. The rule is, if you have to explain any buy or sell action to anyone except yourself, the above is not much use to you. And oh yes, there's a fourth reason too. The above doesn't say anything about the practicality of doing this. Bidding for the stock, missing a month because of vacation, or heaven forbid, 2 months because of illness. So in the meantime, you could not trade. So why do I tell you all this? Because the idea of running ongoing fantasy portfolios is still very valuable. Because an ongoing teaching tool that only costs you time, not actual money. And don't forget, you can also vary the above to see what matters more, what less. For example, you may decide to kick a stock out only if it fell not out of the top 10, but the top 20. So it reduces the turnover and give the high shooters some time to recover. Would it be better? How to tell? Well, you can run 2 portfolios, one with a kick out after the top 10 miss, the other after a top 20 miss. Which will be better? Wait a year or 2 and see. What you'll also see is how much time it took you to do both portfolios. Some fantasy portfolio work better, but are heavy users of your time. While other fantasy portfolios are almost as good in returns, but take very little time. You may decide which you prefer. I know which I would prefer. Now, what about me? About my portfolios? As I told you before, I run more than a dozen fantasy portfolios, some of them almost 10 years. I learned a lot from them. Mostly, yes, what doesn't work, or works well but takes too much time to do, so I don't do it. But other things I learned, I incorporated into my real portfolio with real money, which is why I can stay semi-retired. One last thing. Often the biggest cost is feeling ashamed as one of the portfolios keep outperforming my real portfolio. I mean, a paper portfolio does better than my real portfolio? What do I do then? Then I get a cup of coffee, a big one if I can, to try and see what I can learn from the outperformance fantasy portfolio, and if it teaches me anything, I can incorporate this into my real money portfolio. That's how I learned, by the way, how to catch multi-baggers, and even more critical, how to avoid becoming a bag holder myself. Look up the last chapter of my book, The Advanced Truth Investor, and see the anecdote about the best watch salesman in New York City and how he kept improving his record by incorporating only what worked for him and stopped doing what didn't work for him. That, for me, is the biggest use of the fantasy portfolio to improve my own performance. Get my book and see for yourself. That's all for today. Please let me know in the comment below what you think of the clip above. Give it a like, subscribe to the channel, and tell all your friends what they subscribe to. And buy my books, The Sleuth Investor and The Advanced Sleuth Investor. Read them, and if you like them, give them reviews on Amazon, which I hope will be good ones. I'll see you next time. And meantime, thank you very much for watching.